All right, so last month I had an 80% win rate, and that was on an eval account as I was getting my grounding again. This month, however, things are sliding downhill as soon as I switched over to trading one of my funded accounts. And maybe you've had a similar experience yourself where, you're doing great and then you switch over to a funded or a live account and then it just goes downhill. It seems like you can't buy a win and you start chalking it up to maybe bad luck or feeling even a little bit cursed or like the markets are against you. And if that's the case, I'm going to talk specifically about how to address that and how to overcome that, because there's 3 things to look at when we start feeling like things are not going our way in our trading. So I guess with that said, let's dive in. I'll do a quick review of today, and then I'll talk about these 3 things that are kind of helping me keep my head on straight. Now, so today, actually we can look at the P&L first. So I'll show you last month. So here's last month's performance, kind of a mixture of an eval and a funded actually. I was trading the eval and I started copy trading here in the last 2 weeks between funded and eval. The win rate for that month was approximately 80%, a little bit less. And whereas this win rate's being dragged down because of my performance here in April, which April is only a funded account. Or that's not true, I'm copy trading still, but I'm just showing a funded account here. And the copy trade, the eval is copy traded in the background, not being shown here. So today, obviously we had a wild day here on NQ. Just zooming out, we had the announcement of the ceasefire between the US and Iran, which pushed the market up, almost 4%, 3,600 ticks, 900 handles overnight. So automatically, that was a bit of a red flag, but it didn't mean it was totally a no trade day. So that said, excuse me. I went in on 3 trades today, and I took, I was trying to be patient. If I saw what I liked and what I wanted to see, then I was going to take it. I wasn't going to write it off as a total no trade day. And so this was the first trade that I took, was this long here. It was actually on the 2-minute chart. There was a nice little inversion. I mean, really beautiful setup. 12 a.m. midnight, London low swept, SMT, higher time frame levels, and just didn't want to give anything and smacked me out for a 1R loss. And then this is the trade that maybe I shouldn't have taken, because this inversion right here is what I took. It was really tiny, but I was thinking that any which way, I had to be able to get at least 1R out of this thing. Here's my 1R TP right down in here, super small. Let me make sure you can see that. Yeah, you can see that. All this trend line liquidity and equal highs. I kind of overrode how small the inversion was because of how quality the target looked for. And obviously I got smacked down on that one. So those are my 2 funded trades. And then I took a 3rd trade on a different account, a funded account that just needed to be traded for activity reasons. You have to have X amount of profit to keep the account active. So I took a small trade on that account here. I took this inversion and got a win here on that one. But one of the things that I had noticed after taking those 2 losses is I started to watch my mind make up a bunch of stories. And my mind started to think about things like, okay, here we go again. The last time I switched back to my funded account, I had a bad luck streak. And I really did. I went on, it was like a 20% win rate for that month. And that was February. And it felt like anything and everything that I did, I should have done the opposite. If I went break even on a trade, I should have stayed in it. If I stayed in the trade, I should have gone break even. If I skipped the trade, I should have taken it. If I took the trade, I should have skipped it. And that went on for an entire month. But I learned some very valuable things within that really kind of helped me frame what's going on for my trading right now in this week. And in this case here's a break-even trade. I want to go back to the P&L calendar to kind of give you some context. So started trading this funded, and this day here was when I stopped the previous eval and started trading only the funded. And that trade was a break-even, and it would have been a winner. But I broke even on it. The market was whipsawing quickly, and something was funny, and so I exited on the trade. That was probably the smart thing to do, but nonetheless, that doesn't help my P&L curve. And then similarly on Monday, the market was whipsawing pretty quickly. I wasn't quite sure about if I went in with the right amount of risk on my position. And so I wanted to double check it. So I went break even. And in the amount of time it took me to check my risk on that trade, double check it, I got tapped out at break even and it would have been a winner. And then yesterday was a partial win with a little lower risk than I was expecting. So here's 3 days in a row where something went wrong, right? Break even winner, break even winner. One of those was a partial winner. I forget which, but nonetheless, break even partial winner. And then here's a partial win with less than, how do I say? I risked less than I should have on this trade. It just kind of played out that way. By the time I got in, things were moving quickly. And I was risking maybe like 3/4 of an R kind of thing. And I TP'd. So it was really just like, it kind of felt like a little bit of a loss. And then of course today here is just two full-size losses, minus 2R today. And so what this has me feeling like is here's 5 trades in a row where something went wrong. And I feel like this is where the mental death spiral can start. And you can really mess yourself up if you're not careful here. So what do we do about this? Well, there's something that we need to understand when it comes to these kind of things. I'm going to go back to this chart here and let's do some writing. Let's make this more visible. We'll do nice little blue. I don't know. We have 3 things to consider. We have model variance. See if I can spell. We have market variance, and we have behavior variance. Okay? And all of these things added up equals your win rate and your performance. Now, it's really important when things are not quite going the way we want it to evaluate all 3 of these things. And we can further dissect what's actually going on. So model variance is pretty simple, right? It's our model has a certain win rate. Our certain model, based off of our win rate, let's call it 62%, because that's the number I'm going to be using here in this example. We have a 62% win rate. And within that model and its win rate variance, there's also variance when it comes to winning and losing streaks. And I want to show you this here in a Monte Carlo simulation. So I used just 62% win rate, no break-even trades, and an average of 30 trades a month, and about a 1.5 R result out of your trades. So that's roughly kind of what I'm trading at right now. And the one thing I want to point out when this Monte Carlo simulation is, so this is the most possible scenario. Max consecutive losses is 6. And this is a variance that we need to be aware of within the results of our trading model. And so what I mean by that is, so we take a trade and it's a win, right? We take a trade and it's a break even. We take a trade and it's a loss, 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 break even, loss, win, loss, win, break even, loss, loss. So that probably isn't a profitable sample of trades, but that is totally acceptable within the variance within this trading system. You can see we also have 13 consecutive wins are possible. So, you know, that's a 9 trade sample size. That's actually not a lot of trades to judge anything with, because right after that, it could go like this: win, 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 4 or 5 wins in a row, loss, win, 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 loss, win, break even, win. And now we'll call that double the sample size. Now you have a profitable trading system. So what we can see here is this model variance, right? And I want to denote this point in time right in here, where above this point in time, that's just the variance in the model, but it feels like a losing streak. It feels like everything's going wrong and going against you. And then similarly, this is when you're on a hot streak. But if you don't push through the losing streaks or the tougher periods, you won't get to these hot streaks. So this is variance within the model. And it's important to understand that, because then you have better expectations. So like, I know to expect up to 6 losses in a row so let's say this is within a year time span. I know that I could have 6 consecutive losses, and I know it could distribute in ways that are also difficult to palate, like this, where it's kind of more losses and break-evens than wins, right? So that's the variance within the model. That's something that our system has to be able to handle, and we have to be able to handle mentally. How do we handle that within our system? Is simply not over-risking. So if we have, a threshold on a funded account, obviously if you're over-leveraging, normal variance, model variance is going to take you out and blow the account. Unless you're risking the proper amount where your account can take 6 losses in a row, for in this example, then you're risking the right amount. So that's model variance. That's something we need to understand. The second thing we need to understand is market variance. Now, what I want to point out today, and the reason why I wanted to talk about this is because today was a market variance day and I anticipated it and I chose to trade today. But with my model, and typically what I have noticed is even if I'm wrong on the trade setup, like the one I pointed out right down in here, this little inversion, even if I'm wrong, I often get that 1R. And the fact that I didn't get 1R on either trades today, that to me felt like market variance. So, and that's something that we need to expect because there are periods of time where the market is just favoring our model, right? And that kind of plays into this variance over here where we start stacking wins. And there's periods of time where the market is not favoring our model. Like in my case, I know my model and the way I trade it over time, over the years, because I've back tested several years, I've live traded a year now. I know that there are periods within that market variance where I'm going to be red. I'm going to be red on the month. And, I'm not going to take a minute to pull it up, but you can, just imagine where in some of my back testing sessions and some of my live sessions, I've been red 2 months in a row, but then still been able to have been green on the year. That's market variance to some extent, right? And now the third thing is, and of course, each one of these, like I could make an entire video on these, how to look at it and what to do with it. But I at least wanted to introduce the topic, and then maybe you can dissect it a little further and research it more on your own. But the third here is behavior variance. Now, what does this look like? So behavior variance is when we start interfering with our trades and start interfering with our plan. And maybe this is an example right here. Actually, this is actually a good example. So we have this inversion right in here. Depending on how you played it, let's say, what would make the most sense for my example here? We can just do this. So here's this inversion right in here. And maybe your system is, you take the inversion and you target 2.5R. Something like that. You enter the trade, close above this inversion, and I'm not going to replay this, but just follow my cursor. Basically, you're going into profit on this trade setup. You're like, okay, great, cool. And I'm targeting 2.5R. And let's say you don't partial. And trade comes against you, start getting nervous. And you could do a bunch of things. You could go break even because you're just like, oh, this market's selling off. And so I'm just going to get out of this position, right? And then you went break even though your system said you target 2.5R. And now you just cost yourself 2.5R because the fear in the moment caused a behavioral variance, right? Another example could have been maybe you sat through the retracement and then started going into profit again, but you saw that the market was just going sideways. And then you looked over here and saw this price action. You're like, well, shoot, this thing's just going to go down. So I'm going to close my trade right there at, 0.8R. And then literally 3 candles after you do that, the market rallies to your 2.5R target. Those are two examples of behavioral variances that impact our win rate and our performance. And in both of those examples, obviously you would have turned, you gave up on 2.5R to either realize 0R or 0.8R, depending on maybe what behavioral variance you engaged with at that point. But all three of these things combined, they create our final win rate and performance. So what we have to do is we have to understand our model variance and have expectations, right? That way we don't get wigged out when our model is just doing what it's supposed to do. Within the market variance, we need to be, what do I want to say about the market variance? We need to be practiced enough to observe it or to identify it. Practiced enough to identify it. And with the behavioral variance, we need to be, okay, great. Now I'm going to see if I can spell this word. Disciplined. I hate that word to spell. We need to be disciplined enough and truthful enough to admit it. Okay? And so we have to be disciplined to journal and pay attention to what we're doing. We can't take 5, 6 trades a day and not be able to remember what happened on each trade. For me, 3 trades is a lot for one day. I typically do 1 or 2 at most. Because if we get too many, then I can't remember what I did and why I did it. But we have to be able to look back at our trades and just admit where we were fearful and deviating from our system or interfering with the trade setup. So for me, to eliminate the behavioral variance, one of the things I did is I created a strict set of rules that basically once I enter that trade in that position, I am not allowed to analyze. I am not allowed to do anything else other than execute my take profits and manage my stop loss according to my rules. That's it. I can't exit early. I can't do anything. And that removed the behavioral variance part for me. So what does this mean? Why am I saying all of this? I guess this is turning into a little bit longer of a video than I was hoping for, but maybe it's valuable to someone. I was feeling a little blue after today's 2 losses. The third loss is not shown on the screen, or the third win is not shown. Therefore, it doesn't offset it because I'm just focused on this funded account right here. And a little bit of disappointment after that. But once I sat down and I realized that what I'm experiencing is market variance, because I was able to evaluate it. I was like, okay, model variance, I can expect that a little bit. I can see that. But also what I was noticing is I was able to identify the market variance. Today, this last week and this week, the market has had a lot more variance within it. And so I couldn't identify behavioral. I couldn't find where I did something different than what I should have. I'm taking my model when it shows up and as it appears, and understanding that right now I'm on a little bit of it's ultimately break even, but ultimately my performance has dwindled because the model variance plus the market variance currently is equaling a break even performance. So one of the two will change, whether it's the clustering of wins and losses in the model to offset the market variance, or the market variance will change. So it's just a matter of holding on, seeing what's going on, and not letting the mind start to wander into negative territories and negative beliefs like, oh, I'm cursed, I can't trade, or any of those kind of things. Or the moment I switch to funded, I start losing. It's just normal variance within a system. And so I hope that's helpful. If it is, leave me a comment below if you'd like me to talk any bit in more detail about these variances, because these have been huge for me. These have really improved my trading over the last couple months. And I attribute a lot of that recognizing the variances to why I had an 80% win rate last month, and why I'm not going to let the start of this month, and where was it? The kind of, less than desirable performance, the first, 1, 2, 3, 4, 5 days, I'm not going to let it bug me. It's not going to spook me out. And I think it's really important that we, just as when we're in a trade, controlling our emotions outside of the trade, we need to be able to control our perspective and control our thinking frameworks. So that way we don't roll into debt to the next day going, oh, I'm screwed. I'm in a bad luck streak. No. Instead, I'm going to roll into tomorrow and go like, well, I might take a win because it's just part of the normal variance within the system. Or I might take a win because the market has had some variance within it, so it's likely to smooth out here soon. And I also, just as much as I can see that as a possibility for tomorrow, I also can expect that it could continue. So either way, I think that this is paramount to understand, and I don't think enough traders understand attributing the variance within these 3 categories to what's going on currently to be able to further explain if there's anything to do. You know, if I was having behavioral variances right now, then yeah, I would totally like look at what I was doing and change it up. But I know my model works. I know the market's acting different because of what's going on with Iran. And so then I can just sit back, relax, and accept whatever results I get.